The Iran-Israel war is not just another Middle East conflict. If it happens, it breaks the rules that keep global money, trade, and energy stable. This video is about three things: what breaks, who responds, and what people actually do financially when this kind of system stress hits. I'll mention the protection plan early, come back to it in the middle, and lay it out fully near the end. Let's start with the part most people ignore: international law. Under international law, countries are only allowed to use force in very narrow cases: direct self-defense after an attack, or authorization from the United Nations Security Council. A direct Israeli strike on Iran without an active Iranian attack on Israeli territory sits outside that framework, and US participation in such a war without UN approval would as well. This matters because the global system is not built only on power. It's built on rules that powerful countries claim to enforce. When the rule enforcers start breaking the rules, legitimacy collapses, and money systems depend on legitimacy more than people realize. Now let's talk escalation. Iran is not a weak country. It is not Iraq in 2003. Iran has hardened infrastructure, dispersed missile systems, and the ability to cause catastrophic damage to Israel if pushed far enough. That creates a trap. Israel cannot decisively defeat Iran alone. If Iran responds forcefully, the United States is pulled in openly, not quietly, not indirectly, openly. At that point, the war changes character. It stops being about deterrence. It becomes about regime survival. And historically, when the US enters wars it cannot win quickly, the logic shifts toward regime change. Against Iran, that would be extremely costly and legally indefensible under current international norms. There is no realistic path to a clean, conventional victory here, which is why escalation risk is so high. This is where other major powers respond. China and Russia would not respond first with troops. They would respond with strategy. They would frame this war as proof that the US and its allies enforce international law selectively. That framing matters because it gives political cover for actions already underway: reducing dollar reliance, bypassing Western payment systems, settling energy trade outside US oversight, strengthening regional blocs. China does not need to win a war. It only needs the system to fragment. A prolonged, legally questionable conflict weakens US credibility, drains US finances, and forces allies into uncomfortable positions. That accelerates the shift away from a US-dominated financial order. Now let's talk about trade routes, because trade breaks before currencies do. The Strait of Hormuz handles roughly 20% of global oil. The Red Sea and Suez are already under stress. Even partial disruption doesn't require a full shutdown to cause damage. Insurance pulls back, premiums explode, ships reroute, costs rise and don't fully come back down. Prices move before supply stops. That's why markets react ahead of headlines. This is where the dollar gets hit. Dollar dominance depends on three things: safe trade, predictable enforcement, and consistent rules. An unlawful war breaks all three. The US spends more. Deficits widen. Trust weakens. This does not end the dollar overnight. It kills the monopoly slowly. Countries don't move away from the dollar because they hate the US. They do it to reduce legal and financial risk. And this is how multipolarity actually happens, not speeches, risk management. Before we go further, let's revisit the protection logic briefly. When legitimacy breaks, money moves towards scarcity, control, and insulation from trust failures. And it moves away from leverage, promises, and choke points. Now let's finish the system logic. If the US somehow won quickly and decisively, without escalation or global backlash, the dollar system survives. But that outcome is unlikely. A drawn-out conflict favors China financially, Russia politically, and alternative systems structurally. The longer this drags on, the faster the financial order fragments. Now the full plan: clear, direct, no fluff. Action 1. Get out of leverage. Exit or reduce margin, highly indebted companies, speculative growth, and over-levered real estate. War volatility plus leverage equals forced losses. Action 2. Move into hard assets that don't rely on trust. Gold, precious metals. Real assets tied to necessity. These preserve purchasing power when rules and confidence erode. Action 3. Favor energy that bypasses choke points. Avoid energy that depends on global shipping lanes. Avoid LNG tied to tankers. Avoid offshore supply exposed to Hormuz or the Red Sea. Favor domestic onshore energy, nuclear, electricity, grids, pipelines, and transmission, storage. If it needs ships, it's fragile. Action 4. Reduce long-term dependence on the US dollar. Expect short-term strength. Plan for medium-term erosion driven by war spending and legitimacy loss. Hold more non-dollar exposure. Prefer globally priced assets. Keep less idle cash sitting long-term in dollars. Action 5. Favor pricing power over volume. Buy exposure to essentials. Businesses that can raise prices even if demand weakens. Avoid thin margins, discretionary spending, and anything that needs global calm to survive. What breaks first? Leverage growth stocks, choke point dependent energy, discretionary consumption, fixed income that can't beat inflation. What holds up better? Precious metals, nuclear and electricity, and domestic energy, infrastructure, defense, logistics. This war isn't about territory, it's about legitimacy, trade, money. When legitimacy breaks, money moves first. In the next video, we'll track exactly where capital goes before the headlines catch up.